Hello, everyone, and welcome to this webinar by ClearTax. The topic today that we are discussing, perhaps the most important topic, whether you are salaried or you are self employed, whoever you may be, if you are earning money, then this is going to be very important for you. This webinar, we are going to talk about saving tax, basically, saving tax. And when you save tax, you earn more money, right? So it works both ways. Let's understand what are some of the most popular ways to save tax, and also we'll begin with some introduction to how you can actually go about saving and investing. Some simple hacks to make sure that you are on the right path of saving and investment. So let's get started. And do keep asking us if you have any questions. You can give us a comment or you can write to us at support@cleartax.in and we will surely get back to you. So I'll just begin right away. Hello and welcome to ClearTax. If you've joined in to understand more about how to save tax and basically how to save more money, how to make more money, you're at the right place, because today we are going to give you some simple hacks to saving and investing that are surely going to help you save a lot more tax this financial year. All right. Hi, my name is Preeti Khurana, and today we are going to talk about saving taxes. Actually, saving tax is perhaps one of the most important aspects to making money, right? So the government wants you to pay tax on whatever you earn. If your annual income, if your income from everything, basically your salary, your income from interest that you earn on fixed deposits, if you have any rental income, so your aggregate income where your total income exceeds 2.5 lakhs, the government wants you to come and pay tax on such income. Now there are income tax slabs. Basically your income may be taxed at 5% or 20% or 30%, depending upon which slab you fall in. But usually, like anybody who's earning a salary or anybody who's earning an income which is above the taxable threshold, they will definitely be interested in learning how to save this tax and how to pay less tax to the government. So let's get started. I think before we actually touch upon the topic of tax saving and get into the specifics, I've put together some interesting hacks for you, some really simple hacks that you can actually use in your day to day life, in your financial life, to sort out your finances, to just settle into this mode of saving and investing. Let's go through them quickly. All right. So before we get into the simple hacks, there's a quick look at what all we are talking about. Firstly, we'll talk about the simple hacks. Then we do the must do's, something that you must do if you're if you want to save tax. On your income, then these are the must do's. And then we'll touch upon some common ways to saving taxes. And of course, I'll guide you through what exactly is ELSS and how you can get started with ELSS to save more tax. Right. So these are some handy tips and hacks that I use for my own self, and I thought this would be valuable to all the listeners to, get onto the path of saving and investing. I think what has really worked for me so far is that I usually keep two bank accounts. So I have one account where all my income flows in. So whatever income that may be, could be my salary or any other source of income that I have, that income will flow into my bank account. Let's call it my number one bank account, right? And I have another bank account which is basically my in spending account. So I have another account which is called my spending account. Of course, banks do not offer anything which is called a spending account, but for convenience sake and for understanding sake, I have an account which is the spending account, and I park whatever I want to spend in a particular month into that spending account, and I make sure that my debit card is actually linked to that spending account, and I know how much I want to spend in a particular month. Now, whatever remains in my account number one is what is my investable surplus, and I must park it somewhere. I must invest it at the end of every month. So that's the approach I follow. But you can also follow the other approach, which is you keep one as an income account, basically an account, a bank account where all your incomes come in. And then you open a second account, which is, of course, any other bank account, where you park all the investable money. So you can do all the spending and all the income and the outflows in one account. And you can park another account, which could be your investment account, and make sure that every month, you're actually pulling out money from the income account and parking it to your investment account, and then you have a plan ready to invest that money. So I think this is a very simple way to get onto the path of saving and investing. It really works, trust me. Like if you let's say your monthly income is 50,000, and if your expenses are somewhere around 40,000, then I suggest that you immediately take off 10,000 from your income account and park it to another bank account and call it the investable surplus. And then make sure that you're putting away that 10,000 rupees every month into some sort of an investment. So that's the really easy way to get by this. Um, so that way you are not going to touch upon that 10,000 rupees for your expenses. You're not going to touch that surplus because that will be in another bank account and it will get invested immediately. And like I said, I actually use it the other way around. So I have an income account from where I keep investing, but whatever I want to spend, I take it out into another account, which I call the spend account. And I link my debit card with my spend account. So I keep spending from that account. And it also gives me a surplus sometimes when I'm more diligent, when I don't overshoot my expenses. That's when it leaves me with a surplus. But whatever comes into my income account, I every month do a transfer, and I transfer some balance to my spend account. So this is basically how you should try to manage your money. Of course, you may have another technique, and that also works, so long as you are committed to investing and saving every month. The next important step is for you to define what your goals are. Now, of course, that's a factor of a lot of things. It depends on how old you are, whether you have dependents. What does your medium term goal look like? Do you want to buy a car? Are you interested in buying a property? Are you getting married soon? Do you want to travel? So define your goals. It's not going to be easy. Of course, you'll need um, perhaps a week or maybe more to really think about what you want to do in the next 5 years, and then put them down on a pen and paper. And once you have a goal, what you need to do is you need to combine your investments and your goals. So you need to align these two things so that the surplus that you're putting away every month is actually helping you achieve your goals. So this, in a nutshell, is what your financial life should be based upon. Identifying what is the available investable surplus at the end of every month, and then defining your goals, and then aligning these two things. So making sure your goals are aligned with whatever investable surplus you have at the end of every month. Right. So let's move on to the next important slide, which is actually the crux of this webinar, which is actually the whole idea behind this webinar. Uh, and I'm hoping you got the hang of this very simple hack to go about your money. If you do try it, to let me know. Leave us a comment. We would love to hear from you how this worked out. All right. Uh, these are the some of the must dos of tax savings. So if you, I think you may have heard a lot about Section 80C already. If you have not, then this webinar is going to help you understand what 80C is all about. So basically, the Income Tax Act is divided into various sections because it is a law, and laws usually are divided into multiple sections. Now, one of the sections is 80C, right? There's a section 80 which has something under it, could be 80A, 80B, and a couple of more, and then there is section 80C. Now, section 80C, some people also call the section 80 deductions as chapter 6 deductions. So this could also be called that, but let's call it 80C for now. Section 80C, in a nutshell, like in a very basic language, means that uh, when you take advantage of Section 80C, when you do Section 80C, when you do what is required as per Section 80C, you actually knock off 1.5 lakhs from your total income. As simple as that. So let's say your total income is 8 lakhs, right? Your total income after including everything, so salary, rental, interest income, if your aggregate income is 8 lakhs, then if you take advantage of Section 80C, you're looking at a total taxable income of 6.5 lakhs, right? So it straight away knocks off 1.5 lakhs from your total taxable income. So total income less Section 80C, whatever you get is what you're going to pay tax on. Now, Section 80C actually has uh, so let's quickly understand in a very layman language, what does this section say? It says that if you are making investments in these specified avenues, or if you have made certain specified expenses, you can report them under Section 80C. Now let's look at what these are. So ELSS, which is equity linked saving schemes, or PPF, or payments that you make for life insurance. If you're investing in NSCs, if you have children, then tuition payments. If you've repaid the principal portion of your home loan. So these are some of the items which are covered under Section 80C. What that means is that if you've invested in any of these avenues, could be ELSS, could be PPF, or could be NSC, if you've invested in them, or if you've incurred certain expenses, such as you've paid for tuition fees of your children, which is basically your school fees, or if you've spent money on life insurance, if you've repaid principal on a home loan, then you can actually sum all of that up and you can report it under Section 80C, and you can try to take your total limit to 1.5 lakhs. Right? So you may have PPF, you may have invested 50,000, and then you have, let's say, school fees of 70,000, and you have purchased NSCs for 40,000. So that total is actually 1,60,000, but what you can claim under Section 80C will be 1.5 lakhs. Right? What we've noticed is that a lot of people do not actually utilize this section. So it's very important. Like I said, it knocks off 1.5 lakhs from your income straight away. So extremely important to make sure that you're using this to reduce your total taxable income. Now, like I said, there's this whole array of avenues, investments, expenses which are eligible under Section 80C. But perhaps the most popular one and the one that we are going to talk about is ELSS, which is nothing but equity linked savings scheme, which is nothing but mutual fund, which is equity based. So it invests 65% or more of its total fund value into equities. So think of a mutual fund, which is investing into the equity market, and of the total holdings, like let's say it has 100 crores worth of money that it collected from people like you and me, and of that 100 crores, at least 65% at any point in time is parked in equity shares, right? And the balance could be in debt or in any other avenue that the fund manager may consider appropriate. But ELSS must have an equity holding of 65%. Now we know that equity holding is actually linked to higher returns, like way higher returns that what you can get from a fixed deposit or a PPF. And of course, it comes with a little risk because we are talking about equities and there is some inherent risk involved. So, how to go about this? Like, should you go for PPF? Because PPF is actually an extremely popular product. It has been used by our parents and their parents. So we've seen that, diligently our parents have invested money in PPF. But the reality of our times is that the returns that are offered by PPF, although they are not taxable, but they are fairly low. Like you're looking at an 8%, 8.5% return on your PPF deposits. But if you consider ELSS, you're looking at nearly a 14 to 15% return every year. And, so ELSS actually comes with a 3-year lock-in, which means that as an investor, you will not be able to get out of the product before the end of 3 years. But by the end of 3 years, or actually if you are committed for a slightly longer duration, like if you're committed to staying invested for up to 5 years, you will see phenomenal returns in this product. So this has worked brilliantly for investors. So especially if you're young, and of course most of us, not me actually, but most of us, who are young, we are impatient and we are ready for some high returns, and we are okay with some risk, because we may be at such a stage in life that we are ready to take on some risk, because equities come with inherent risk. And if you're looking at a far better return, like compare 8% or so with a PPF against nearly 15 to 16% on ELSS, a lot of us must actually consider ELSS to cover our section 80C. So like I said, I'll just quickly recap. So Section 80C is actually the most important section for tax saving. It has various investments and expenses that you can use to finish your 80C. But the most important one is definitely your ELSS. Now, how should you go about ELSS? We are going to organize a couple of more webinars. We are going to talk about ELSS in detail. But I'll just talk a bit more about other avenues, which could be HRA. So if you're living in a rented accommodation, then you can claim your house rent allowance. This is the allowance which must appear as part of your salary. So if you look at your payslip, it must have a row which says HRA, and that's when you become eligible to claim HRA, right? So two conditions: A, that your employer is providing you HRA, it is appearing in your payslip, and secondly, you're actually living on rent. Trust me, that's very important. So you must be getting HRA, and you must be living on rent and paying rent to your landlord. If you're doing so, then make sure that you're claiming your HRA. Your employer may ask for certain documents. They may request for a rent agreement. They may ask for rent receipts. Actually, rent receipts are pretty common, and ClearTax has an excellent tool which you can use to prepare your rent receipts, and you'll be able to get those proofs instantly. So yeah, HRA is very important if you're living on rent. The other is Section 80D, which comes in the Income Tax Act right after Section 80C. You don't need to get into those details, but I'm just telling you it's another section which allows you to save tax if you purchased a health insurance. So you can buy a health insurance for yourself or your spouse, your parents, your dependent children, and whatever money you've spent on that, you can claim it 25,000 for yourself and your spouse, and 50,000 for parents who are more than 60 years old. This is another excellent way to save on tax. Medical expenses are really hitting the roof. If you're in any of the metro cities, it's becoming harder and harder to take care of your medical bills unless you have an insurance. So God forbid, if there's any situation, you must have a health insurance policy. And if you're making payments for a premium, then you must claim it under Section 80D. Here I would just like to point out that certain employers who take a group insurance policy may also request you, they may give you that option that you can enroll your parents at a slightly, higher premium. So you may have to pay that premium from your own pocket, and you will be able to insure your parents. And that extra premium that you're paying, to your employer so that he can pay for premium for your parents, even that money you can claim under Section 80D. So if you've covered your parents through your employer and you're footing part of that insurance premium, then make sure that you're claiming Section 80D. NPS is another interesting option if the National Pension Scheme, where you open an NPS account, you make deposits, and so you can claim it under Section 80C, and you can actually, if you're making additional contributions, then you can actually claim it under Section 80 CCD1B as well. But we'll touch upon that in one of our later webinars. So stay tuned, subscribe to us. You'll see a lot more videos coming in on tax saving. Remember that if you have a home loan, then I assume that you will be taking care, you will be claiming the interest that you're paying on the home loan in your tax return, just the way Section 80C knocks off 1.5 lakhs. Paying interest on a home loan can reduce your taxable income by rupees 2 lakhs. So this is an important aspect. If you're making EMI payments, then make sure that you are claiming the tax benefit on this as well. Now, there are some other ways to save tax, which could be if you've done a recent travel in the financial year. If you've traveled anywhere, then you can claim your LTA, which is your leave travel allowance. Some people also call it the LTC, which is the same thing. So there's no maximum amount which is defined in the Act. And just mind you, this is not part of ATC. So this is available separately. Usually your employer may set a limit of how much you can claim. But remember that you're only allowed to claim the fare of travel. So I'll give you an example. Let's say you're going from Delhi to Bangalore and you've booked, a flight to travel to Bangalore on a holiday. In that case, only your airfare from Delhi to Bangalore and back is eligible for an LTA claim. But if you're taking a cab from your home in Delhi to the Delhi airport and then from Bangalore airport to a hotel, or if you're spending money on local sightseeing, all of that is not eligible to be claimed under LTA. It's only the fare, could be airfare, could be rail fare, or if you've taken a taxi, you can also claim taxi fare. There are certain restrictions on it has to be, you have to look at the airfare of the national carrier if you've taken, and if you've traveled by air. So there are certain restrictions on that, but as such, make sure that you submit your bills if you've traveled, claim that money, and you're going to save tax on it straight away. Do remember that this is only for travel within India. So if you're making international travel, you're not eligible to claim LTA on that. All right. Also, I'd just like to remind all of you that there are no reimbursements for medical bills. Up till the last financial year, which is 2017-18, one could claim medical bills, but that has been done away with. Now it has been replaced by a standard deduction of rupees 40,000. What this means is that if you're looking at your total salary, let's say your total salary is rupees 5 lakhs, right? You are eligible to get a standard deduction no matter what. So you can straight away, your tax return will show a net amount of 4,60,000. 40,000 rupees will be straight away knocked off from your salary income. So that's what standard deduction means. It has been introduced for the first time in this financial year, and I'll quickly let you know that in case you are filing on clear tax, we'll make sure that you automatically get this deduction without having to do anything. So if you're salaried, you can be assured that clear tax will take care of this, and you will be allowed a standard deduction of rupees 40,000. All right, these are some must do's. Then there are some other ways to save tax. We'll just quickly look at these as well. If you, in case you haven't had a chance to go for a health insurance premium, then perhaps you can get a health checkup done, and you can claim rupees 5,000 under Section 80D, which we just spoke about. You can also get health checkup done for your parents, but the maximum you'll be able to claim on account of a health checkup would be restricted to rupees 5,000. Also, do remember that if your employer is allowing you any sort of reimbursements, if you're eligible to claim your telephone bills, your cab expenses, if you're traveling for work, let's say you're going to a client location and the employer has promised to reimburse those taxi bills, or if you have any meal expenses which have been incurred for, on behalf of your employer, then you submit all these bills on time, because if you don't, then you may not be able to claim that money, and the employer will not be able to pay it to you. So if you have any reimbursements, like we spoke about, that medical reimbursements are no longer allowed in financial year 18-19, but anything else that you're eligible to claim, please make sure that you do it on time. Right. So there are some deductions which are available if you have disabled dependents. You can claim medical expenses of a disabled dependent under Section 80DD, where disabilities covered are hearing impairment or autism, blindness, low vision, locomotor disability. So if you're caring for your parents who are disabled, unfortunately due to something, then you can claim this deduction. Where the disability is 80% or more, then you're eligible to claim 1,25,000. That's a lot of money, and I'm sure you may be spending all of that for in taking care of them. So the Income Tax Act allows you to claim this. Also, people who are undergoing treatment for specified diseases, say renal failure, malignant cancers, or certain neurological diseases, they can claim deduction under Section 80DDB. The maximum claim eligible is rupees 40,000 or rupees 1 lakhs for 1 lakh for those who are above 60 years old. So in this case, you may require a certificate from a specialist, who's going to certify that a certain person is suffering or is undergoing treatment for the specified disease. And I've just listed a couple of them here, but there's a whole list of specified diseases. You can find it on our website, and you can talk to a specialist. It may not be, there's no requirement in the law. They've recently changed the law and said you can even go to a private practitioner, so long as he's a doctor by authorized by the medical council, may not be in a government setup. You can go and take a certificate and claim this deduction. All right, these are some other ways to save tax. And now, a quick recap on what ELSS can do for you as a taxpayer. So, if you've been investing otherwise in fixed deposits, or other avenues, or leaving your money in a savings account hoping for a 4%, 5% return. That's actually a very ineffective way of going about your money. Like I said, you must get onto this path of keeping two accounts, and I'll recap it for you. So, one account should be your income account, and the other account could be your investment or spend account, so that you have clearly demarcated the money that you are allowed to spend, and you invest whatever is left after that. uh, Once you get onto that path, you must consider choosing ELSS. ELSS is an excellent way to save on taxes. Have a look at the offerings by ClearTax. Let me tell you that the funds that we've chosen, so our ELSS funds are actually handpicked, and they've returned nearly 18%, phenomenal returns over the past year. And you may be able to double your money in 4 to 5 years. And you can, ELSS for ATC, you can do a SIP or you can do a lump sum investment. Let's say you're sitting right now, December is almost about to begin, and if you want to invest and you don't have all the funds right now, then you can actually do a SIP. So you can consider a SIP of 20,000 rupees for December, January, February, March. That makes it 4 months, and you will have 80,000 rupees parked into ELSS, and you would have saved tax. And and then you can actually continue that SIP into the next financial year. So you can then start continue with the SIP, and you may be investing in the same fund in April and May and so on of the next financial year. The benefits of doing this via ClearTax is that you see absolutely no paperwork. So we don't do the traditional ways of investing. It's actually much smarter. You can view your performance anytime, so anytime you can just log in and check how your fund is performing. You can download your proof instantly. So let's say if you make an investment, we make sure that you have the proof immediately, and you can go and submit it to your employer. uh, and then you're done with your tax saving exercise. Everything done under 5 minutes. So I'll just recap it. So you'll have ELSS funds which are recommended, which are cherry picked by our experts who have more than 30 years of experience in this field. They're going to help you. They have recommended certain funds. Go for those. Invest completely paperless. See your performance anytime. See how your fund is doing, and then download your proofs instantly, and you're on your way to saving taxes. I hope that helped answer some of your questions around tax saving. So let us know, yeah, hi. Let me know if you have any questions, and I'll be happy to take them. I hope you found that session useful. Um, In this session, we attempted to address some very basic issues around tax saving, around investing, and sort of highlight ELSS to you, the benefits of getting into ELSS, the kind of returns that you see from ELSS. So do ask us if you have any questions, write to us, and let me assure you, we are going to be coming up with a lot of webinars, and you will see us many times during the week. So keep your questions ready and come back to us the next time. We'll surely try to answer everything that you want to ask. Thank you and have a good day. Bye bye.